Good evening, all. Ira Epstein, and here we are with your financial market wrap-up, and this wrap-up is for Monday, and we're at the 9th of September, 2024, just getting on to 6:30 p.m. Central Time. Interesting day. We have finally gotten some bounces in the stock indices, but the question is, are they bear market bounces or what? Here's the dilemma you're facing. The Fed is going to cut interest rates, whether CPIs that come out this week and PPIs are hot or ice cold. Doesn't matter. They're going to make their move. Will it be 50 or 25 basis points? To me, it doesn't matter either. All right? People will look into it. Should the Fed get ahead of the curve? Which way? They've started their rate cutting cycle. You'll see that it's September 28th. We'll hear the words, what they're watching. My guess is they're going to be data dependent. My guess is they're looking hard at the labor market, just what they told you before. They're going to say if inflation numbers come in benign or declining, they'll say that inflation is going in the right direction, and now their job is to make sure we get a soft landing and that they become supportive to labor. That's what I expect to be said, so I'm not expecting big changes. You will say, well, what do we do with these markets? Well, number one, I pay attention to seasonals, and September is typically just plain a bad month. Number two, the market valuations are high for a market like this that isn't getting the AI boom that it wants. In other words, NVIDIA is mature. Yes, I believe when Blackwell does come out, they will have sales galore on that new chip, but it's been delayed. Now, how delayed? I don't know, but it could be months again. Today, I saw the Apple phone come out, and I watched everything there, and I wanted to see what it would be, and I left with a chill. There was nothing there to make me go out and tomorrow or Friday, when you can order your phones, run and say, hey, I got to get this on the list. I got to have this phone. There's nothing that made me want to do it. Number one, I'm not a professional photographer. So all the AI, all the better parts that they're doing, I love them, I want them, but not enough to spend $1,000. Number two, the speed on my 14 is still pretty good for what I do. Number three, I can't get the benefit of AI because the phone that they're releasing won't even have AI until at the earliest October. And how do I know it's October? So I can keep that money in my pocket a while, let everybody else run out and get what they want, let the surge happen if there is a surge, and we'll take it from there. I thought the phone was more interesting. The watch phone, I like that better. And, you know, the sound geeks will always want a new pair of iPods. But do I think it was dramatic for Apple? No. So I'm just looking at where the market's at on valuations. And I say this because I look at this and I say to myself, is this worth chasing? And I'm not seeing it right here. I still think the story is the market wants to bring markets down to right valuations on those that got excessive. Apple could be one of them with a high here than Meta and others in terms of PEs. Maybe that's the case. I don't know. All right. In the metal markets, I don't see anything stopping inflation. What I see is inflation cooling. Absolutely. But I don't think anything here that's going to say, we've turned the corner and we have a zero. Do you see that in any of the CPI or PPI numbers? Because I'm not seeing that. So I expect a down. And then I think as the market revalues with the PEs, could take 30 days or longer. If I'm right on my scenario, and I could be very wrong, I think you come back maybe October. And you start looking at the market for my friend Santa, who is right now packing all the goodies up and getting ready to visit us. Because the market will say things will be better in 2025 if we don't run away in prices right now and make the valuations too high. And all we did, and I think you'd agree, from June on, we were going to be at 5,200, then 5,400 in the S&P. Then we went to 56. Then I saw it, and I said, this is like the top. Somebody came out and said, we're going to 6,000. And nothing grows to the sky is what I said when I saw that. Little bit of a rally in the dollar. I don't know that it's going anywhere for the same reasons that I just told you. Once the Fed starts cutting, they're saying that they've got to prop up the economy. Do you buy the dollar as they're propping it up? I don't think so. I think you're going to see interest rates fall. I think the economy's numbers will slow down. I'm not convinced that's what you want to do. I think traders will be looking elsewhere in a number of currencies to see what they offer. On the energy market, as I said last week, there's no way OPEC can increase production under this environment. The question is, will the U.S. and other non-OPEC members do any cutting back? Are they going to do anything as prices fall? I did see today that the Biden administration did buy about 3.5 million barrels of oil. They got it done for the SPR. They didn't say the price they bought it, but they said that they did buy it for delivery in 2025. So they wrapped up. They did great with that because any way you cut it, you're near $70. They sold it approximately 90 on up in the market. I know what Joe can do. He can be a trader. He seems to have a knack for that. All right. In terms of data tomorrow, you've got the National Federation of Independent Businesses coming out at 5 in the morning. Redbook Group will come out with the U.S. retail sales data at 7:55. Let's talk about the state of the consumer. This afternoon at 2 o'clock, the Federal Reserve U.S. consumer credit headlines came out. So you went from an expectation of 11 billion increase in credit up to 25.5, one of the biggest jumps I recall. You had the revolving credit go up 10.6 billion, non-revolving 14.8. The share of auto loan balances that have become at least 30 days delinquent are now the biggest since 2010. Doesn't sound like a strong consumer. The share of credit card debt that is newly delinquent has risen to 9.05%, the most in 12 years. So when people say the consumer, I don't think he's dead, but he's spending enough to dig a hole for himself, and this is problematic. If interest rates fall, and it's reflected, and it often is a big lag on a credit card, the interest, it's not going to do them a lot of good. Think about that. It will help homes when interest rates fall and other things, but this is a big problem because people are living credit card to credit card month. And if you don't believe me, those are the numbers. When we look at the S&P, I know that I told you as the market was up here and we started coming down, I said it wouldn't surprise me if we went back to the 18-week moving average of closes and decided to fight a battle there. I don't know anything more I can say because that is exactly what is going on. That is your battleground. You're at 54.88 tonight, the 18-day average 54.78, and for the week, you've already hit 54.05. So you've certainly gone through that. Next, and that's a close-only chart, by the way. When we look at the E-mini S&P on a daily bar chart, you can see how it's pulled back. And when you look at the chart, you have a pattern of a higher high and a lower low. That is not a trend. It's as though the rug got pulled out of the market and you're getting a bounce. This is not a change of trend. This is no more than a bounce in a market that fell hard. It found its first support at the 100-day average, a major moving average. I said if it didn't pay attention to that last week, then it could go here and or the Bollinger Band, and the Bollinger Band came right in with the 100. So those two numbers for the moment have offered the support in the market. I see the resistance, if it can rally up, around the 55.79 level. And I say, I'm not quite certain what to do here. You have an oversold market that's had a vertical price drop. It needs to get away from being oversold for me to get interested in selling it, and it's not doing it. Any reading under 30 keeps me in the oversold camp. When I go to the NASDAQ, lower highs, lower lows here too. We talked about this last week. Went to the 200-day average in the Bollinger Band, and for the moment, getting a bounce from there. Could it work lower? Absolutely. Is this a bounce in a market that now has overhead resistance? Absolutely. The 100 and the 18-day average are two resistance points. We then come to the micro Dow. and it fell back to the 18-day average. I said maybe you can get to the Bollinger Band. We can take a look at this. And all of these happen, a lot of these, when you had embedded readings. Do you remember that? And I said if you've taken my course on this, you really learn a lot. Here you're embedded. You don't have a reading under 79. Here you do. So the first objective, and often it's the main objective, is the 18-day average of closes. Now, if it gives ground, you're either going to fight at that number or often make a run to the next series of support, which, for the moment, is the 100-day and the lower Bollinger Band. The market makes its plunge, and now it's making a fight at that. That's all that it's doing. Is it trending? It is not trending at all. It's also no longer oversold, but it's not giving you much to do. And in the Russell, you have fallen back into the 100 and the lower band. And again, the bands held the market on the first break to them. And again, I think you're too early to be buying the Russell. You do remember 3 weeks ago, it was bullish on TV. We have rotation going on. It's not the Mag 7. This is a very bullish event. And they pulled the rug on you temporarily. Game isn't over. The word is temporarily. In the bonds and notes, well, I'm still in the SEP here. I think it's time that we move to the Indices, but in fact, I'll do that today because this is not the ones to be trading. I made a mistake in leaving these up. I've got on my morning subscriber video the Indices, and I just didn't see it. Basically speaking, looking for markets that ultimately, especially in the bonds, can rip your head off to the upside. It wouldn't surprise me. In other words, I'm looking for interest rates now to do the inversion, to do the continued pattern, because once these cycles begin, they keep going. And you want to be careful. You don't want to be too early. You want to buy the breaks in the market, is my opinion in the market. In the dollar index, September's still the right one that you look at. The market is over the 18-day average on a closing basis. It's been doing this, and then it keeps dropping away. We'll see if it does that again tonight. The euro backing off a little bit here. You still have the pattern of higher lows, but lower highs. There is no trend now in the euro. In the British pound, you're in a downtrend. Could the market make a run for the Bollinger Band? It could. The first thing it's got to do is prove that it can't hang on to the 18-day average. And no, if you were to tell me, hey, Ira, let's go short there to find out, well, you'd have to have a stop over this last high. It's more than $600. I don't think that's worth the risk. I am not surprised that in an oversold market, eventually the market paid attention to the lower band and gave you a bounce. But this is a bearish event, not a bullish one. As this market comes out of oversold, you just had a bearish crossover in the 18-day to the 200. I could be wrong, but I'm expecting that to be a big resistance point if and when it's hit, if and when. On the energy market, it looks to me like you're trying to lock in a bearish embedded reading. If you do, this market can latch onto this band and go down even further. This is not a pretty chart. Same here. So if anything, you're ingraining more bearishness. I'd love to get away from that, but I'm not seeing it. You already have it in October heating oil. It's fully embedded, so the rallies are getting sold by the pros. And in the nat gas, did you not hear me talk for 2 weeks? I said I thought that we could rally back to the 18-day average and the market would fight. But ultimately, as you get into the last quarter of the year, this market starts rolling over, just the opposite of what people think, because you've already built up a lot of your supplies. This is the funny part of the year. We'll have some days where we get into the 80s, and we're going to have that in Chicago for 10 days. This morning, I woke up, we were 49 degrees. So you're getting these radical swings, but you no longer need your air conditioning, and you don't need your heat. So my bills are going to fall through there on that. So that gets very interesting as far as I'm concerned. Take advantage of the free offerings we have, especially our price counts. If you've never seen them, go here to iraepstein.com. Take a look if you've not seen it. That's the reason, one of them, you want to be with a firm like us. The things we offer, simply put, are phenomenal. They're not things you see everywhere. our staff of writers on our research, I'll put them against anyone. Most of us have 25 to 30, 40, 50 years of experience. Yeah, you heard me. It's from Dave Hightower to Gordy Linda comes out on this. We've been around this. We grew up on the floors of the exchange. We've written so many reports, we get blindsided by them. But you learn these things. We bring them to you just like the way you see that. So when you click on the blue, and that's what you'll do, eventually you'll get finished. And as you scroll to the bottom of the page, it's going to ask you for your name and all. It's in a cart for you. As soon as you hit send, comes right to us. Within about 48 hours, we get everything out to you. I'm Ira. Thank you for watching. I'll catch up with everybody first thing in the morning. Take care.